and we'll have more news when we return. Credit Suisse to borrow up to 54 million from Switzerland's central bank. Credit Suisse will borrow up to 50 billion Swiss francs from the Swiss National Bank under a covered loan facility as well as short-term liquidity facility, the company announced Wednesday. Credit Suisse is one of the only 30 global financial institutions that the International Financial Stability Board has designated as being systematically important, too big to fail, per Axios' Felix Salmon. Credit Suisse's largest shareholder, Saudi National Bank, said earlier Wednesday that it couldn't provide any more capital because of regulations and added that it couldn't own more than 10% of the bank. The protections provided by the Swiss Central Bank are fully collateralized by high-quality assets, per a statement from Credit Suisse. Credit Suisse also announces offers by Credit Suisse International to purchase certain OpCo senior debt securities for cash up to approximately CHF 3 billion, the statement added. Credit Suisse CEO Ulrich Körner said in a statement that the measures demonstrate decisive action to strengthen the bank as we continue our strategic transformation. What began 1 week ago as a California bank trying to sell some stock has morphed into a global crisis of confidence in banks, even if Credit Suisse is in trouble long before people have ever heard or had ever heard of SVB. And from Ripple's Nigeria, Credit Suisse majority investors sparks fear among bankers and shareholders. Fear of Credit Suisse going under has gripped the Swiss capital market after its majority shareholder, Saudi National Bank, SNB, said it could no longer provide funds for the Swiss lender. Saudi National Bank, which brought 9.9% stake in Credit Suisse last year, revealed that it could no longer provide capital whenever the lender was in need of a financial bailout. In 2022, Saudi National Bank participated in a $4.2 billion fundraising run by Credit Suisse, pledging an investment value of 1.5 billion Swiss francs. According to the largest investor on Wednesday, providing more capital will push its stake to 10%, which will breach the regulatory restrictions that prevent the shareholder from holding 10% ownership. Saudi National Bank Chairman Ammar al-Qudairy told Reuters that we cannot because we would go above 10%. It's a regulatory issue. Although he doused fear of Credit Suisse in need of financial assistance, stating, I don't think they'll need extra money. If you look at the ratios, they're fine.
The whole notion of logic.
I don't think they'll need extra money. The comment was enough to spark fear among equity investors as Credit Suisse's shares its share fell for the first time under 2 Swiss francs, $2.17, the Swiss capital market. It recorded a new all-time low, trading around 1.78 Swiss francs at some point during Wednesday's session, and fell as low as 30% before regaining part of the loss by closing down at negative 24%. The fear among the capital market followed the failure of 2 major banks in the United States, Silicon Valley Bank and Signature Bank. Both banks liquidated due to the financial crisis amid soaring inflation and increased interest rates in the United States. This has sparked fear of contagion in the European financial markets. As a result of the fear of financial crisis in Swiss credit, which posted 7.3 billion Swiss francs loss for 2022, Swiss authorities released a statement to assure of financial support if the lender needed it. The Swiss Financial Market Supervisory Authority, FINMA, and the Swiss National Bank, SNB, assert that the problems of certain banks in the USA do not pose a direct risk of contagion for the Swiss financial markets. The strict capital and liquidity requirements applicable to Swiss financial institutions ensure their stability. Credit Suisse meets the capital and liquidity requirements imposed on systematically important banks if necessary. The SNB will provide CS with liquidity, FINMA and the Swiss National Bank said in a joint statement. And from Financial Times, Europe will simply not allow itself to be overshadowed by the U.S. in a news cycle about banking stresses. Credit Suisse has said it plans to borrow up to 50 billion Swiss francs from the Swiss National Bank in fully collateralized transactions. It's also buying back $3 billion in senior debt securities, according to a statement on its site Thursday morning. The show of support from the SNB, the Saudi National Bank, has in the short term had the requisite effect on the share price. CS is up 22.5% at pixel time, and perhaps more importantly, credit default swap prices on Credit Suisse have fallen back again. Credit Suisse also reminds investors that it's a GSIB and had a liquid coverage ratio of 150% on Tuesday. As of the end of 2022, Credit Suisse had a CET1 ratio of 14.1% and average liquidity coverage ratio of 144%, which has since improved to approximately 150% as of March 14, 2023. The use of the covered loan facility, the CFH 39 billion, will further strengthen the LRC with immediate effect. Credit Suisse is conservatively positioned against interest rate risks. The volume of duration fixed income securities is not material compared to the overall high-quality liquid assets portfolio, and in addition, is fully hedged for moves in interest rates. Moreover, the loan bank's highly collateralized at almost 90% with more than 60% in Switzerland, and an average provision for credit loss ratio of 8 BPS across wealth management and the Swiss bank. Still, Barclays macro strategist wrote Wednesday that they're becoming more concerned about the vibes-based sell-off that's expanded beyond the U.S. regional banks. Because vibes affects deposits and deposits outflows matter quite a lot too, from Barclays. As our equity and credit analysts covering Credit Suisse also noted, we believe that this crisis is not about asset quality. It seems to be a liquidity crisis driven by deposit outflows and a steady stream of negative headlines about the Swiss bank, and it has the potential to matter considerably at a macro level if not tackled. The European and U.S. banking systems are far better capitalized than they were in 2008, but in today's market move, even extremely well capitalized and healthy European banks are seeing their AT1 bonds drop sharply in sympathy. If not stopped, confidence crisis can spiral into solvency issues. For instance, throughout the euro area crisis, the only clear solvency crisis was Greece, yet highly solvent sovereigns such as Spain got entangled in worries that the ECB wouldn't stand behind the banking system unconditionally, and that any conditionality was too politically painful for individual countries within the Eurozone to accept. Without decisive action on the liquidity front, markets will ultimately ask the question of who's next, even for banks that currently have the confidence of investors. The SNB's liquidity provision could qualify as decisive action. One can only hope it doesn't spook markets too badly, especially ahead of the upcoming ECB rate decision later today, where a 50 BP rate increase was even seen as a sure thing until yesterday. Financial Times does not sound confident, as it usually does. It's usually blindly confident, and right now, the banking system is not that way. And from SingingAlpha.com, Credit Suisse stocks jumped 32% as lenders secured $54 billion loan from Swiss National Bank. Shares of Credit Suisse listed on the Swiss exchange jumped over 32% on Thursday after the troubled lender said it'll borrow up to 50 billion francs from the Swiss National Bank. Its U.S.-listed shares gained 9% before the bell. Credit Suisse also announced public lender offers by Credit Suisse International to repurchase certain OpCo senior debt securities for cash up to 3 billion francs. The lender's shares took a beating on Wednesday, dropping more than 30% to 1.55 francs, amid growing concerns over its liquidity after its top shareholder ruled out offering further financial assistance. The comments came a day after Credit Suisse disclosed that it identified a material weakness in its reporting procedures and was developing a remediation plan to address the same. Note that the bank said its 2022 results released last month were not impacted by the material weakness. The market reaction pushed the Swiss National Bank and the country's financial market supervisory authority to assure investors that Credit Suisse meets capital requirements. They added that recent failures in U.S. regional banks do not pose a direct risk for contagion for the Swiss financial markets. Now I'll open up a channel here. Beam me up.
Beam me up, Mr. Spock.